You've been programmed since your very first paycheck to do one specific thing. You get the HR form, you check the box, and you shovel as much cash as humanly possible into that 401k. You're told it's responsible, you're told it's safe, but nobody talks about the feeling you get when you realize you've locked up your entire net worth in a box you can't touch without a penalty, effectively partnering with the IRS on a business deal where they refuse to tell you their percentage of the profits until the very end. That anxiety you feel about taxes isn't paranoia, it's math. And there is a specific mathematical tipping point where adding one more dollar to your tax-deferred accounts actually hurts you. It lowers your flexibility, spikes your future tax bill, and creates a problem most retirees don't see until it's too late. I'm talking about the tax torpedo. Here's the rule you need to know right now before we look at the projections. It's called the Rule of 25 Inverse. If your current 401k balance projected to grow at a modest 7% until age 75 will result in required minimum distributions that exceed your annual spending needs, you need to stop contributing today. Not tomorrow. Today. You have overfilled the bucket. If you want simple money math that turns panic into a plan, subscribe. I'm Mint. To understand why stopping is a valid strategy, we have to look at the game board. The government gives you a tax break today to incentivize saving, but they aren't doing it out of the kindness of their hearts. They are deferring the tax because they expect to collect more later. When you turn 73 or 75, depending on the current law, the IRS forces you to start withdrawing money whether you need it or not. These are RMDs, or required minimum distributions. Think of your 401k like a balloon. You keep pumping air into it, those are your contributions. The market pumps air into it, that's your compound interest. If that balloon gets too big by the time you retire, the pressure, which is your tax liability, becomes explosive. You want a balloon that floats, not one that pops, and takes 30% of your wealth with it. Let's run the numbers because this is where the vague financial advice falls apart and the real math begins. Meet David. David is a 45-year-old. He's a diligent saver. He earns a good salary and has managed to save $500,000 in his 401k. He plans to retire at 65. He currently maxes out his 401k every single year because he hates paying taxes today. If David keeps maxing that account, putting in the $23,000 limit plus a match, and gets a 7% return, do you know what happens? By the time he is 65, he has around $3 million. Sounds great, right? Who wouldn't want $3 million? But watch what happens next. He lets it ride until RMDs kick in at 75. By then, with growth, that account could easily swell to $6 million. The RMD factor at age 75 is roughly dividing your balance by 24. That means the IRS forces David to withdraw $250,000 in a single year. Add his Social Security to that. David is now showing a taxable income of nearly $300,000 a year in retirement. He doesn't need that much money to live. He only spends $80,000 a year. But he has no choice. He gets pushed into a massive tax bracket, his Medicare premiums double due to RMDs surcharges, and 85% of his Social Security becomes taxable. He spent his whole life trying to save on taxes only to hand over a fortune in his 70s. Now, let's look at a different scenario. Let's look at Sarah. Sarah is in the exact same boat, 45 years old, $500,000 in the 401k. But she runs the projection I just showed you and realizes she's on track to overfill the bucket. She decides to stop contributing to the 401k entirely, except for the employer match. Never give up the match, that's free money. Instead, she takes that $20,000 a year she was putting into the 401k and redirects it to a standard taxable brokerage account. She pays the taxes on that money now. It stings a little bit today, but look at her flexibility. By age 55, Sarah wants to retire early. Because she has built a pile of money outside of the retirement jail cell, she can access those funds without penalty. She doesn't have to navigate Rule 72 or beg for a loan. She just sells some index funds. She pays capital gains tax, which is significantly lower than income tax, and she bridges the gap to retirement. When she hits 75, her 401k is healthy, maybe $2 million, resulting in a manageable RMD that keeps her in a low tax bracket. She kept the balloon from popping. But here is the part people miss, and it's critical. It's not just about the tax rate. It's about the sequence of returns risk. If all your money is in a 401k and the market tanks the year you retire, you still have to pull money out to pay bills, selling shares at a loss. If you have that taxable brokerage account, the liquidity bucket, you can spend that cash while waiting for the 401k to recover. You are buying yourself an insurance policy against a bad market. So, how do you find your number? How do you know if you are David or Sarah? You have 3 levers you can pull, and you have to pull them in the right order. Lever 1 is the growth assumption. You need to be realistic. If you project 10% returns, everyone overfills the bucket. Use 6 or 7% real returns. If your 401k balance doubles every decade, a $500,000 balance at 40 becomes $2 million at 60 and $4 million at 70. Is $4 million inside a tax bomb too much for your lifestyle? For most people, the answer is yes. Lever 2 is the income need. Calculate your gap. This is your annual spending minus your fixed income like Social Security and pensions. If you spend $80,000 and Social Security covers $30,000, your gap is $50,000. You only need a portfolio large enough to generate $50,000 safely. If your RMDs are forcing you to take out $200K, you have a mismatch. Lever 3 is the bridge. This is the money you save in a taxable account or a Roth IRA. This is the lever that gives you freedom. The 401k buys you a comfortable old age. The bridge account buys you your freedom in your 50s. Now, I promise to show you the common trap, the mistake that ruins this whole strategy, even for smart people. It's called the tax torpedo, specifically regarding Social Security. The US tax code has a weird quirk. As your income rises in retirement, it drags more of your Social Security benefits into the taxable bucket. There is a window where for every dollar you withdraw from your 401k, you might be creating $1.85 in taxable income. It creates an effective marginal tax rate that can spike over 40% or even 50% for middle-class retirees. If you blindly fill that 401k until you're 65, you are marching straight into the path of that torpedo. By stopping contributions early, once you hit your coast number and diverting to a brokerage or Roth, you keep your taxable income lower in retirement. You defuse the torpedo. You might pay 20 to 2% tax today to save yourself from a 40+% effective hit later. That is the trade nobody explains to you at HR. But don't do this yet. Don't just cancel your contributions tomorrow morning without checking one thing: the psychology of spending. The danger of the taxable brokerage account is that it's accessible. The 401k is great because it's locked up. You can't impulse buy a boat with it. If you shift your strategy to a taxable account, you need the discipline to treat it like a vault. If you start rating it for renovations or cars, you aren't building a bridge, you're just spending your future. Here is the mint move. This is how you execute this without needing a CPA degree. First, go to any simple compound interest calculator, plug in your current 401k balance, and run it to age 72 at 7%. Write that number down. Second, take 4% of that future number. That is your rough projected RMD. Third, look at your current annual spending. If that projected RMD is double what you actually spend to live, you are done. Stop the 401k contributions beyond the match. Direct every extra dollar to a Roth IRA first. If you earn too much for a direct Roth, look up the backdoor Roth. If you've maxed that, open a plain vanilla brokerage account and buy the same low-cost index funds you would have bought in the 401k. You are building a tax diversification strategy. You want 3 buckets: tax-deferred, pre-tax 401k, tax-free, Roth, and liquid, brokerage. If you only have the first one, you are financially fragile, no matter how high the number looks on the screen. It feels weird to stop. It feels like you're breaking the rules. But the goal isn't to have the biggest 401k at the graveyard. The goal is the most spendable cash flow with the least amount of stress. You've checked the math on the tax bomb. Now you need to figure out how to actually move that money around if you've already overfilled the bucket. That's where Roth conversions come in. I'm going to break down exactly how to build a Roth ladder to get that money out early without paying penalties in the next video. Go watch that one next. I'm Mint. See you there.